Hello, in today's video we're going to discuss purchasing a house within your budget and your income range. We're also going to talk about debt to income ratios and how lenders calculate these things in order to figure out how much a buyer would qualify for a home purchase. If you have any questions, please visit us at coasttocoastlending.com or call us at 904-810-2293. The first thing the lender is going to ask from you regarding the qualifying process is going to be questions and documentation regarding the income of the household. And that's going to include, of course, pay stubs and tax returns and documentation to support this. But basically, they're going to want to know your gross monthly income. If you're a salaried W-2 worker, simple pay stubs will show that. If you're an hourly rate worker, they'll look at that along with any overtime that you may work as well. Part-time income, that is also going to be included as long as it's documentable income and that it's been income that you've received for at least 2 years. They'll also look at additional income the household may receive. This can include things like Social Security income or maybe disability income. And then they'll also look at the continuance of that income and how long it will continue. So debt to income ratios are really the calculation that lenders look at in order to formulate how much of a purchase price or loan amount that a borrower would qualify for. And there's going to be two ratios here that they look at. There's a top ratio known as a housing expense ratio, and then there's also a bottom ratio, which includes the housing payment plus any other debt that you may have. So we'll start out and just look at the top ratio. Again, this is just the housing payment. This includes the principal and interest on your mortgage, the monthly property taxes, the homeowner's insurance is also included in this. Now, this is normally limited to about 30% of the buyer's gross income or the household's gross income, whoever's used for qualifying on the loan application. That 30% though, that's not set in stone, that limitation, 30% of the gross income. That can fluctuate depending on a number of variables, including the loan program type, the down payment amount, and then other compensating factors that lenders look at. Sometimes that can go as high as 40%, again, depending on certain factors. Generally, borrowers that have maybe a very high credit score or they have a good amount of savings in their bank, things, additional compensating factors that reduce the risk of loans, sometimes lenders will allow that number to go much higher than 30%. It's important to also know that when they're talking about the debt ratio, the top ratio and the housing payment, that does not include things like your monthly utility payments or maybe your cable TV, those type of things. That is not included in this. It's just the principal, interest, taxes, and homeowners insurance, and then homeowners association fees, if applicable, that can be included as well. So for one example, we'll look at Mary. Her gross monthly income is $5,000 per month. If we take 30% of that, that would be $1,500 per month. This is the maximum allowed for Mary's mortgage payment in this scenario. Now, it's also important to know that always purchase a home within your personal comfort zone and your budget, okay? Because again, this does not include all the external things that come with home ownership, again, like utilities and the inevitable home repairs and things of that nature that just come up. Now we're going to look at the bottom ratio, debt ratio, that includes the housing payment plus all the other debt. Okay, this would include debt that is reported on your credit report. car loan, maybe you have a car loan payment, credit card payment. Those are examples of things. Uh, Things like your, let's say your monthly cell phone payment, that would not be included in this. That's generally those payments, uh, certain things like that are not reported on your credit. Now, depending on the loan program, again, and many other variables, the down payment and other compensating factors, that bottom end ratio is normally limited to 42 to sometimes as high as 50% of the gross qualifying income. So in this example, again, Mary, her gross monthly income is $5,000 a month, and 42% of this is $2,100 per month. We already know that Mary's housing payment is $1,500 per month. So if we add to that her car loan, she has a car loan, let's say that's $450 per month, and then she also has a monthly minimum credit card payment of $50 per month. So if we add all those things together, we have the bottom ratio. Okay, that's $2,000 per month, and that keeps her just under the 42% limit for, again, the bottom housing ratio plus all the other reoccurring expenses and installment loans and things of that nature. Home buyers that have questions and want to learn more, again, can reach out to us at Coast to Coast Lending or call us 7 days a week at 904-810-2293. Thank you for listening.